Bloomberg Audio Studios.
Podcasts, radio, news.
Susan Collins is the president of the Federal Reserve Bank of Boston, and she joins us now on Bloomberg Radio and television around the world. Thank you very much for getting up in this lovely rainy day here in New York and joining us.
Delighted to be here.
Let's start with the elephant in the room, CPI. It came in hotter than expected this past month, and now you have yourself and others suggesting we're not in any hurry to cut interest rates. Markets seem to be taking this as a policy turning point. Is it?
I wouldn't characterize it as a turning point. So you're absolutely right that the inflation numbers that came in this week were on what I would call the high end of what was expected. And if you look at the first quarter, certainly inflation is elevated compared to where it was as we ended 2023. At the same time, it doesn't change my baseline outlook that inflation will continue to come down with a healthy labor market. I just think it will take more time, and it's premature to tell whether the elevated numbers that we just saw are a bump along that path or something more concerning. So I don't see it as a significant turn, but important to continue to look at the data holistically and let the data tell us what's really going on.
Well, the markets, to go back to them, have priced out everything except maybe 1.5 rate cuts by the end of the year. Is it fair to say that, unlike them, you really don't know what you're going to do?
Well, policy is not on a preset path. And I think that's important. I think there's a maybe understandable desire to have us map out exactly what's going to happen. But in the current environment, what's really called for is patience, being very methodical, and looking at the whole constellation of information, not just focusing on one data reading or another one. And so what I would say is that we're continuing to form our outlook, recognizing that there are uncertainties and there are risks. So I call myself a realistic optimist in that sense, realistic about those risks and uncertainties, but still, for lots of reasons, very optimistic that we will see inflation come back down and that labor markets will remain healthy.
Well, how unconvinced are you that inflation is not going to come down as rapidly as you might have thought?
So I do think that we're going to have to be patient, and it may take more time. That is one of my takeaways from some of the data that we've seen. You know, at the same time, the data are mixed, Mike. So yes, the most recent inflation numbers have been elevated compared to what I might have hoped for. But at the same time, if you look at things like wage rates, so wage growth has been faster than it was pre-pandemic. But once you factor in the past price increases and, importantly, the productivity gains we've seen, the wage growth that we're seeing is consistent with that trajectory back down to 2% inflation. And I think that's good news for workers as well. But my point is that you need to look at the range of data and not focus too much on one piece, and take the time to really see what the takeaways should be.
Well, you said yesterday that the danger of over-tightening has kind of moved out of the picture at this point. Growth is strong, unemployment remains low, inflation is at least sticky, if nothing else. Why cut rates at all?
So I wouldn't say that that there is no risk of us waiting too long. I do think that it's two-sided, but to your point, I certainly do see more reason to focus on making sure that we don't start easing too quickly. We're resolute. I'm certainly resolute about that commitment to bring inflation back down to 2%. You know, I do see policy as being moderately restrictive at this point, and it, in my view, will be appropriate as we get closer to that trajectory. It will be appropriate to begin easing, but we're not there yet. So I don't think that we would indefinitely certainly want to stay where we are. My baseline would still have us starting to ease later this year, but when I see is likely to be later than I had been previously thinking.
I have to ask because everybody's going to bring up the question is, does the election interfere with timing?
Absolutely not. As I've said a number of times, focusing holistically on the data is really what determines appropriate policy. And I have to say, there's enough of that to keep us very busy. So that is my focus, and that's the focus of the committee.
You mentioned policy is moderately restrictive. What tells you that? And how do you know what level of restrictiveness you need?
So in terms of the last piece, that's where watching the data comes from. Are we seeing the balance of performance that we're looking for over time? Certainly there's evidence of some restriction. We've seen housing market reactions. We've seen some increase in delinquencies. We've seen some declines in capital spending. And so there clearly is evidence in a variety of places. Labor markets are coming into better balance, and that's a really important one. At the same time, consumption and demand have remained perhaps surprisingly strong given where interest rates are and what we might have thought based on history. But we've seen in a lot of contexts ways that the current context is somewhat different. So I would characterize where we are as policy is having a restrictive effect, which is what we want, but is perhaps moderately restrictive, and that calls, again, for patience and being methodical as we look at all of the data.
We've now got pricing basically for a December rate cut as markets move back and forth. But my nerdy economist friends have spent the last 2 days putting PPI and CPI into the PCE calculations. And everybody is saying PCE is going to come in much milder than both of those. If that's the case, can we say June might be back on the table?
So I don't want to speculate again, not a preset path, and I think we have to wait to see what the data tell us. But to my earlier point, the data have been mixed, and CPI and PCE don't always move in lockstep. They certainly are very closely related. And so I think we have to wait and let the data tell us what's happening. And again, it's not just the PCE, although that is certainly the preferred measure that we are focusing on when we look at our 2% target. It's all of it and how it comes together collectively. So wage data will be important. When I look at the price data, I also want to disaggregate and look at what's happening to the different components, because the dynamics there are different, and that's informative for trying to understand where we might be going, not just where we've been. The key question is, where are we going, and what's that outlook like, and trying to get to greater confidence before we change the policy stance.
Former St. Louis Fed President Jim Bullard once said during the aftermath of the financial crisis, whatever you think the right rate for the country is, this isn't it. Are you anxious to cut? Do you want to cut? Do we need a cut? Or can we live with rates at this level?
Well, in the near term, I don't see urgency. I had been a bit concerned earlier in the year, very early in the year, that there might be some signs of labor market fragility. I'm seeing much less reason for concern, but that again is why I see the risks as being two-sided. So I don't see urgency, and I see lots of reasons for patience. And over the longer term, I think my expectation is that we will ease, and that over the longer term, interest rates will be at lower levels, but exactly what that looks like, it's really premature to be too specific.
The data may be mixed, but what are CEOs in your district saying about both employment growth and also about whether or not they're still having to raise salaries and whether they're going to have to raise prices?
Yeah. So, and we do have many conversations with people throughout our district, large firms, small firms, throughout New England. And what I'm hearing is a couple of things. One is quite a bit of optimism in terms of the economy's performance overall. I'm hearing information consistent with labor markets really coming into better balance, being easier to hire, except in a couple of sectors like healthcare, where that can still be quite a challenge. So, it's there are differences across different sectors and localities, but that firms have not been expecting the same kinds of wage increases that they had needed before to retain workers. Quit rates are way down. Much less turnover. And that helps with productivity, right? Because if you are focused continually on having to fill those gaps because people are leaving and then you have to train people to come up to speed, it's hard to maintain that productivity that firms really need. And that's part of the good productivity story that we've seen that has helped with economic growth and helped us to bring inflation down as much as we did in 2023, despite the fact that growth has been continued to be so robust. So there's a strong supply side story there as well.
Well, productivity is one half of potential growth, and you're talking about productivity being good. A lot of argument these days that we're seeing more immigration than we're really accounting for, and that basically potential growth is higher than we thought it was. Do you agree with that?
So I certainly have seen increases in labor supply as being a key part of that supply improvement story that has certainly benefited the economy. And the labor supply increases have included immigration, and there's been a lot of work which has come from different people finding similar stories in terms of the increase in immigration playing a role. But we've also seen an increase in labor force participation, particularly in prime age workers, that was not anticipated, and really notably among prime age women, even though we know that the childcare challenges continue, and those are really quite stark. So there have been some surprising supply improvement news, and we'll have to see the extent to which those continue, but it's certainly been an important part of the story so far.
One last question for our money market desk friends. That is, you had a staff briefing and a discussion of whether or not and when to taper quantitative tightening. The agreement, apparently, according to the minutes, was that you should announce it fairly soon. Can we expect something like that at the June meeting?
So no decisions were made. The minutes summarize the discussion that we had, and it really draws from lessons from the past period of quantitative tightening from 2017 to 2019. And some of the key lessons from that experience are the importance of doing the tightening, in other words, runoff of the balance sheet, in a way that is smooth and does not cause stresses. That proverbial should be like watching paint dry, right? It shouldn't be unexpected. And so there was broad agreement that slowing the pace, which is currently about twice as fast as it had been in that earlier period, and doing so sooner to ensure that it continues to be quiet and orderly and passive in the background. Broad agreement for that, and also to start that sooner. But no specific decisions have been made yet.
So we could get taper before we get a rate cut.
Those things I see them as being independent, so that could happen.